Rele, firstly, your view on the fact that we've seen the markets rallying so hard. Have you been taken aback by the fact that the market really has managed to start gaining back some of its losses from 2011?
I think that the key for the market has always been confidence in the banking sector. Without that, it was always going to be a struggle. I think that we started the year reasonably well for selected banking names, but when we saw profit warnings in the middle of the quarter, that confidence was once again shaken. What we see now is that the full year results are all out, and in most cases the Q1 numbers are out, and so we're seeing, there were some strong performances still in 2011 full year numbers, and we're seeing a strong performance in the first quarter, especially from the larger banks. We're in an environment where the rate environment that is favorable for banks with cheap funding bases, and we're seeing that come through in the Q1 numbers, which I think is helping to support the market.
Really, which of the top tier banks, or which of the banks overall, have most surprised you with their quarterly results?
I would say that I suppose First Bank is probably the strongest relative to our expectations. GT Bank usually is at the front of the pack, and the numbers were stronger than our expectations. But I think in terms of on a relative basis, we were more surprised by First Bank. I mean, I think that net interest margins of 9.5% in the first quarter is a very strong number indeed. They've managed to maintain the sort of cheap funding base despite the fact that we are in a higher rate environment, and they've basically managed to grow earnings mostly by placing money in securities, but also by improving the yield on their loan book. So there's a two-pronged approach, which kind of encourages us on sustainability. Our thing with First Bank has always been that they have a tremendous amount of scope to leverage, some of their natural advantages. In terms of efficiency, they had room to maneuver. In terms of reaching out to a more profitable long-term demographic, they had more room to maneuver. And we're starting to see those things come through. And they also offer more value on a relative basis than some of the larger banks. So at 0.9 times 2012 book, we still prefer First Bank versus Zenith, that is at 1.2 and delivering lower ROEs.
You're talking about Zenith. Those were the latest numbers to come out. Profit after tax coming in at 19 billion naira. That was a 28% rise there versus the quarter one in 2011. Standouts for you from those numbers that came through, as you say, lower ROE versus the likes of First Bank right now.
Yes, and I mean the reality is that Zenith Bank does have a higher capital base, higher capital adequacy ratio, and as a result of that, will sort of lag its peers on the ROE basis. Now, the thing with Zenith has always been that we've taken comfort from stronger asset quality on the whole versus even a GT and certainly a First Bank over time. But in the final quarter of 2011, we also saw Zenith Bank take higher provisioning. So the question really is, if we're going to receive lower returns and we're not completely assured of lower risk, then suddenly it becomes a less attractive prospect. Let's go with the First Bank that is cheaper, that is going to be more sort of efficient in delivering returns on an ROE basis, and perhaps offer me something similar on the asset quality front. So Zenith Bank will still do well, but I think now it kind of needs to probably begin to drive more risk in terms of, so that it can kind of be benchmarked favorably against its peers.
Let's look at AMCON, because disclosing yesterday that it has 5 trillion naira worth of assets, that makes it the largest financial institution in Nigeria. So what is the future for AMCON looking like right now, given the fact that it has so many assets under its management right now?
Well, AMCON, let's not forget, is a public sector entity at the end of the day, and it's not a bank. Yes, it has a number of assets, but the genesis of AMCON was to be a resolution vehicle for the sector. It is now sort of having helped to sort of navigate the sector away from what was a very precarious position, and the sector is now positioned much more firmly. AMCON also needs to think about paying for itself and making sure that it when it comes to the end of the sort of the sort of first tenure whilst it will not expire, but this initial kind of resolution period, it will be able to pay for itself without having recourse to the federal government, even though it has a guarantee. So we've seen assets taken at a premium from the banking sector. We've seen injections and so on. But I think going forward, we'll start to see AMCON taking a much more commercial stance, for want of a better word, when it comes to asset purchases. The idea is not that AMCON should continue to rescue the sector. The idea is that it takes assets out of the sector at a price that makes it unfavorable for banks to want to sell to them. That's the idea. So the asset quality is improved, and if they do have to buy, they have a reasonable margin to ensure that they can make a profit on the assets that they buy and fund themselves. So we're reasonably comfortable with AMCON's outlook at present. But of course, over time, we want to see more numbers coming through and see how these things progress over time. But the sinking fund will also obviously be a key element of AMCON funding itself, and so we're reasonably comfortable right now.